Look at what is happening in the headlines right now because you are being told a story that might end up costing you thousands of dollars in unnecessary taxes. There is a massive wave of information circulating on social media and major news outlets claiming that Social Security is finally tax-free. They are pointing to the One Big Beautiful Bill Act, which everyone is calling the OBBB, and they are telling you that because of the new $6,000 senior bonus deduction, the Internal Revenue Service is finally off your back. I am here to tell you that if you believe those headlines without looking at the fine print of the 2026 tax code, you are walking straight into a trap. I have spent the last few weeks digging through the updated IRC section 701103 and comparing the 2025 tax year to the 2026 tax year. And the reality is much more complicated and much more dangerous for your retirement nest egg than the pundits are letting on. The confusion starts with the standard deduction. For the 2026 tax year, the basic standard deduction for a single filer has moved up to $16,100. If you are over the age of 65, you get an additional standard deduction of $2,050. On top of that, the OBBB has introduced a brand new $6,000 bonus deduction specifically for seniors. When you add all of those up, a single person over 65 is looking at a total deduction of $24,150. For a married couple filing jointly, that number jumps to over $48,000. This is why people are celebrating. They think that if their income is below these high numbers, they owe nothing. But here is the massive problem that the IRS is not highlighting in their brochures. The IRS does not use your standard deduction to decide if your Social Security benefits are taxable. They use a completely different, ancient, and honestly cruel formula called provisional income. This provisional income formula was created in 1984, and it has never been adjusted for inflation. Think about that for a second. In 1984, a new car cost about $10,000, and a gallon of milk was barely $2. Everything in our economy has changed, but the thresholds for taxing your Social Security have stayed exactly the same for over 40 years. The IRS looks at your adjusted gross income, adds back any tax-exempt interest you earned, and then adds exactly 50% of your Social Security benefits. If that total number is more than $25,000 for a single person or $32,000 for a married couple, your Social Security is no longer tax-free. It does not matter how big the new OBBA standard deduction is. The standard deduction is applied after the IRS decides how much of your Social Security is taxable. This is the hidden pivot point where so many retirees are going to lose money this year. Let us look at a specific example so you can see how this math actually destroys a retirement budget. We will talk about Bob. Bob is 67 years old. He lives in Florida, and he is a single filer. Bob has been hearing these rumors that 2026 is the year of tax-free Social Security, so he feels confident. Bob receives $3,000 a month in Social Security, which comes out to $36,000 for the year. He also has a traditional 401k that requires him to take a distribution of $40,000 this year. Finally, he has some modest investments that pay him $5,000 in dividends. Bob thinks he is in great shape because his total income is around $81,000. But he assumes that since Social Security is supposedly tax-free now, he only needs to worry about the other $45,000. He figures his $24,150 deduction will wipe out half of that, and he will pay a tiny bit of tax. But when Bob fills out the Social Security benefits worksheet in the instructions for Form 1040-SR, the trap snaps shut. First, the IRS takes half of his $36,000 in Social Security, which is $18,000. Then they add his $40,000 distribution and his $5,000 in dividends. Bob's provisional income is now $63,000. Because $63,000 is significantly higher than the $34,000 threshold for single filers, the IRS mandates that 85% of Bob's Social Security is now taxable income. 85% of $36,000 is $30,600. Now, look at what happened to Bob's adjusted gross income. Instead of just $45,000, his AGI is now $75,600. This is where the second trap of the 2026 law kicks in. The new $6,000 senior bonus deduction under the OBBB starts to phase out once a single filer's income exceeds $75,000. Because Bob's Social Security became taxable, it pushed his income over that limit. Bob is now losing the very deduction that he thought was going to save him. He is getting hit from both sides. He is paying taxes on money he already paid taxes on decades ago, and he is losing his new tax breaks. This is what we call the tax torpedo. It is a phenomenon where every extra dollar you take out of your retirement account actually costs you much more than your tax bracket suggests because it triggers more taxes on your Social Security and reduces your eligibility for other credits. Before we go any further into the specific strategies to stop this from happening to you, I need to ask you a huge favor. If you are finding this breakdown helpful, please hit the like button and subscribe to this channel right now. We are in a brand new tax environment in 2026, and the rules are changing faster than most people can keep up with. By subscribing, you are making sure that you have an advocate in your corner who is willing to read the thousands of pages of tax code so you do not have to. Also, please share this video with one friend or family member who is retired or nearing retirement. There is so much misinformation out there about the 2026 tax changes, and sharing this could literally save someone you care about thousands of dollars this year. We are building a community here of informed investors who refuse to be victims of the system, and I would love for you to be a permanent part of it. Now, let us get back into the mechanics of why 2026 is so different from 2025. In 2025, the tax brackets were still governed by the older system, but in 2026, we have a new alignment. For a single person in 2026, the 12% bracket ends at $50,400. For married couples, it ends at $100,800. This sounds like a lot of room, but remember Bob? His taxable income ended up being over $51,000 because of that Social Security inclusion. That means Bob just got pushed out of the 12% bracket and into the 22% bracket. Every dollar he took out for his grandson's car was not taxed at 12%. It was effectively taxed at over 40% when you account for the Social Security taxability and the phase out of his deductions. We also have to talk about the stealth killers that people forget until it is too late. The first is IRMAA, which stands for the Income-Related Monthly Adjustment Amount for Medicare. In 2026, the thresholds for Medicare Part B and Part D premiums have shifted. If you are a single filer and your modified adjusted gross income from 2 years ago, which the IRS is looking at right now, was over $109,000, your monthly Medicare premiums are going to skyrocket. We are talking about an extra $100 or more per month per person. That is not called a tax, but it is a government-mandated payment based on your income, so it functions exactly like a tax. When your Social Security becomes 85% taxable, it artificially inflates your income and can push you right over that Medicare cliff. The second stealth killer is the state tax situation. As we sit here in 2026, there are still 9 states that insist on taxing your Social Security benefits to some degree. If you live in a state like Minnesota, Utah, or Rhode Island, you are facing a double whammy. You are paying federal tax on your benefits because of the 1984 formula, and then your state is taking another bite of the apple. Even if the federal government gives you a $6,000 bonus deduction, your state might not honor that deduction on your state return. You have to check your specific state's Department of Revenue guidelines for 2026 because many states have not updated their laws to match the federal OBBB changes. So how do you fight back? How do you actually make your Social Security tax-free in 2026? The first and most powerful tool you have is the Roth conversion. If you have not reached the age where you must take required minimum distributions, you should be looking at the 2026 tax brackets very closely. Because the 12% bracket is so wide this year, it might make sense to convert a portion of your traditional IRA into a Roth IRA. Yes, you will pay tax on the conversion today, but once that money is in the Roth, it is gone from the IRS's radar forever. Roth withdrawals do not count toward your provisional income. If Bob had converted his 401k to a Roth 5 years ago, his $40,000 withdrawal would be invisible to the IRS today. His provisional income would have stayed under the $25,000 threshold, and his $36,000 in Social Security would be completely 100% tax-free. This is why tax planning is a long game. The second strategy is for those of you who are already over the age of 70 and a half. You need to be using qualified charitable distributions or QCDs. In 2026, the limit for QCDs has been adjusted for inflation to $112,000. If you are planning on giving money to your church, a charity, or a nonprofit, do not take the money out of your IRA and then write a check. That is an amateur move that will trigger taxes on your Social Security. Instead, have the money sent directly from your IRA to the charity. This way, the money never hits your tax return. It does not count as income. It does not show up in your AGI. And most importantly, it does not get added to your provisional income formula. It is the cleanest way to reduce your RMDs and protect your Social Security at the same time. The third strategy is what I call the tax bridge. If you need extra cash for a large purchase, maybe you want to renovate your kitchen or buy a new car like Bob did, do not just pull it all from your traditional IRA. Look at your total portfolio. If you have a brokerage account with long-term capital gains, the 2026 tax rate for those gains is still 0% for many middle-income retirees. If you take some money from your brokerage account, some from your Roth IRA, and only a small amount from your traditional IRA, you can keep your total taxable income low enough to stay under the Social Security thresholds. You have to be an architect of your own income. You cannot just leave it to chance or assume the IRS will give you a break. Finally, you must look at Form W-4V. If you realize after watching this that you are going to owe taxes on your Social Security, do not wait until next year to deal with it. The IRS will charge you penalties if you owe too much at the end of the year. Download Form W-4V and tell the Social Security Administration to start withholding a percentage of your check. You can choose 7%, 10%, 12%, or 22%. It is much easier to manage your budget with a slightly smaller monthly check than it is to come up with $5,000 in April when you realize the OBB didn't save you as much as you thought. I know this is a lot of information, and it can feel overwhelming to navigate all these numbers and form names. But the reason I am so passionate about this is that the government relies on you being overwhelmed. They rely on people just checking the boxes and paying whatever the software tells them to pay. But you have worked too hard for too many years to let 30 or 40% of your retirement check vanish into a 1984 formula that makes no sense in 2026. You deserve to keep every penny of the Social Security you were promised. If you want to dive deeper into these strategies, I have prepared a comprehensive 2026 retirement tax guide that walks you through every single threshold, every bracket, and every form we discussed today. I have put a link to it in the description of this video. It is a step-by-step resource that you can take to your accountant or use yourself to make sure you are optimized for the new year. It includes a specific worksheet where you can plug in your numbers and see exactly where your tax torpedo zone begins. Please, if you found value in this breakdown, take a moment to subscribe and click that notification bell. I am going to be releasing a series of videos over the next month breaking down the 2026 changes to inheritance taxes, capital gains, and the new rules for 529 plans that you need to know about. Also, I want to hear from you. Leave a comment below and let me know if you were surprised by Bob's story. Did you realize that the standard deduction and the Social Security tax formula were completely separate? Your questions help me decide what topics to cover next, and I try to respond to as many of you as I can. Thank you for trusting me with your time and your financial future. It is a responsibility I do not take lightly. Share this video with your friends, give it a thumbs up, and let us make sure that 2026 is the year we all finally take control of our taxes instead of letting them control us. Stay informed, stay proactive, and I will see you in the very next video to continue this journey together. You have the power to protect your wealth. You just need the right map to do it. Let us get to work on your 2026 plan today.